Gold has surged to a new all-time high, over $3,200 an ounce on the stunning breakdown of values on the U.S. Treasury and dollar markets, giving gold truly explosive upside potential that few realized was possible even a few short weeks ago. In this gold market commentary for Friday, April 11th, 2025, I'll explain why. Hi, I'm Dana Samuelson, president of American Gold Exchange in Austin, Texas. We are a national physical precious metals and vintage U.S. gold and European coin dealership. If we can help you with any of your physical needs in the precious metals arena, we'd love to have that opportunity. In this gold market commentary, U.S. bond blowout boosts gold. I'm going to explain how gold has spiked on turmoil in the U.S. Treasury market and how the Treasury market disruption could be breaking confidence in U.S. bonds, giving gold truly explosive upside potential. We've seen silver rebound from short-term lows, but we've also seen the gold to silver ratio spike higher, which is creating a stunning opportunity for silver buyers. And we have two sovereign minted 1 ounce silver coin specials to offer, which we didn't think we would have. So let's get on with our update. This is a headline I took off of Bloomberg just this morning, Friday, April 11th. U.S. Treasury slide in worst sell-off since 2019. Jamie Dimon, president of J.P. Morgan Chase, predicts Treasury market kerfuffle where the Fed steps in. And I think it's very possible that the Fed could be forced to intervene in the Treasury market. China has capped tariffs on U.S. at 125% and calls Trump levies a joke. And in news of the day, it appears that President Trump has reached out to China to potentially de-escalate this dramatic tit-for-tat tariff increase, which has caused all this market turmoil. One of the analysts that I like to follow is a guy by the name of Luke Groman. Luke is brilliant. And last November, I saw him give a presentation where he explained that there's been strong demand for short-term U.S. Treasuries coming primarily from what he called the ULICs, the UK, Luxembourg, Ireland, the Cayman Islands, Switzerland, where there are hedge funds and tax shelters located. When I saw Luke give this presentation, I understood intuitively that unlike the normal holders of long-term U.S. Treasuries like sovereign governments like Japan and China and the United Kingdom, which are the three largest holders of our Treasuries for sovereign governments, when you have hedge funds and tax shelters trading primarily short-term Treasuries, if the market goes against them, the only fiduciary responsibility they have is to their own profits. So if that happens, if the market goes against them, they'll dump. And I think that is what has led the charge on this breakdown in U.S. Treasury values over the last 3 or 4 trading sessions and spiking yields as a result. And the problem here stems from the fact that due to the big fluctuations we've seen in interest rates going back to 2022 and 2023 as a result of the Fed fighting inflation, the Treasury has sold mostly short-term notes because that's what they've been able to sell over the longer duration notes. If you buy a long duration Treasury at a low yield like 1% or 2%, and the yield goes to 4 or 5%, well, you're losing money on those Treasuries. And that's specifically what caused Silicon Valley Bank and Republic Bank to fail in the fall of 2023. Spike in Treasury yields. So when you have the short-term hot money getting out of the market, that could lead the charge here towards lower values for U.S. Treasuries. And I think that is what has been the case. And if you look at who holds short-term Treasuries, you'll see that they are located in Ireland, Luxembourg, the Cayman Islands, United Kingdom, and Switzerland and Belgium, just as Luke indicated. This is a chart of holders of equities, long-term debt, and short-term debt, according to the U.S. Department of the Treasury, going back to 2024. Now that's leading the charge. But if we have some of the larger holders of U.S. Treasuries, like Japan or China or the United Kingdom, starting to sell, that could cause some real disruption past what might just be an episode. And I think that that's where the real rub is here, and the potential for problems in the Treasury market going forward are. If we see foreign money that has been supporting our deficits for years start to leave our Treasury markets because they don't trust it, it creates a real problem for the United States in supporting our $36 trillion debt and what is going to be a record 6-month deficit for the US. And I think it's going to come in at 1.4 trillion from September of 2024 to the end of March 2025. And it could lead to higher interest rates, which would cause our debt service to increase all over the already $1.1 trillion that we paid over the last fiscal year to finance our debt. And if we see a spike in Treasury yields and our interest rates go higher, that would mitigate anything that Elon Musk and Doge are trying to do now in reducing the costs of our debt. So this is specifically why I believe President Trump capitulated on the morning of Wednesday, April 9th, and paused the tariffs, the reciprocal tariffs, because of disruptions in the U.S. Treasury market. Now, I do think that the 10% tariffs are here to stay because they're here to pay for the tax cuts that President Trump wants to enact as part of his three-pronged strategy: tariffs, tax cuts, and deregulation. So we need to have those 10% tariffs to raise capital to provide for the tax cuts to make that neutral. Now, in addition to that, of course, the tariffs that were announced on Liberation Day were much higher than most people ever imagined they might be. And I believe that's because President Trump wants his legacy to be that he balanced the budget. But you do that by diminishing the deficit down to zero. I listened to a fascinating interview. One of my friends, Victor Menashe, who is a real estate developer, have with George Ross, who is President Trump's former business partner. And in the interview, the notes of which I'll show you below so you can access it yourself, George Ross says that is what President Trump wants his legacy to be, that he balanced the budget. And that's why he's being so aggressive. But when you hit people in their pocketbook, like what has happened specifically with the stock market over the last week and a half, people remember that. And this is politically, potentially a real problem for President Trump when the midterms come around. And he's on an 18-month leash right now to try and get to the gain, to get us through the pain that we've been going through and the disruption we've been going through. If we don't get to the gain by the midterms, all of this will be for naught. And that's why he's being so aggressive in his policies and pushing things so dramatically. But what's happening is he's causing a lot of distrust in the process. This is another Bloomberg article from April 9th. Treasuries are trading like risky assets in a warning to Trump. Treasuries and the dollar get their strength from the world's perception of the competence of American fiscal and monetary management and the solidity of American political and financial institutions, said Jim Grant, founder of Grant's Interest Rate Observer, a widely followed financial newsletter. Possibly the world is reconsidering. And that's what we've been seeing. the world is reconsidering. So let's take a step back and think about what's happened over the last couple of weeks. Small business makes up about 50% of our economy. And if you're a small business owner reliant on imports from other countries, and suddenly these aggressive tariffs are announced, you're going to have dramatically higher input costs than you expected to have. And in the weakening economy like we're having, you can't necessarily pass those higher costs off to your customers. And in the interview I did last week with Danielle DiMartino Booth, she elaborates on this. The margin squeeze that businesses are already going through right now before the tariffs are enacted. So small business to medium business owners are having a real struggle right now trying to decide what, if anything, they can do to deal with tariffs are on, tariffs are off. It's creating a ton of uncertainty, which is why we're seeing such market gyrations. Now let's take a step outside of the US. And for many big companies and countries, the US is their best customer. So what happens when your best customer suddenly tells you on very short notice, hey, I want a 10% discount on everything you're selling? Because when we levy a 10% tariff on them, that's basically what we're asking for to keep prices neutral, a 10% discount. Well, what if that discount is 20% or 47%, as in the case with Vietnam, or over 100% with China? Well, the first thing you're going to do is try and negotiate to save your business in the short run. And that is what President Trump is pushing these entities to do, to negotiate. So this is a negotiating tactic, in my viewpoint, above the 10%. It's a complete negotiating tactic to try and eliminate the deficit to the best of our ability. But the second thing you're going to do is you're going to go find new customers. So you're not as reliant on the biggest customer that you have. And let's take that a step even further. When the US weaponized the dollar by sanctioning Russia after the Russian invasion of the Ukraine, what happened with the BRICS countries? They decided they wanted to try and shun the dollar and do as little trading in the dollar as possible. Because if we can sanction Russia, we can sanction them. But the dollar's embedded in the world's financial system, so shunning it's really hard to do. But if you own gold and have gold in a vault, it can't be sanctioned or seized. And we've seen central bank gold buying double in the last 3 years to over 1,000 tons a year. Between 2011 and 2021, central banks on average, following the great financial crisis, were buying 500 tons of gold a year. Over the last 3 years, they've bought 1,000 tons of gold a year, which is material because the mines produce about 3,500 tons on average. Now, what happens if the other half of the world decides they don't trust the US Treasury market anymore? They don't trust our treasuries. They won't buy our debt because we're too erratic and it's too risky. The last safe haven asset standing is gold. And that's why this whole equation creates dramatic upside potential for gold, much higher than we have seen in the past. You know, just a month ago, I said gold should be $3,300 to $3,500 this year. It's already $3,240 today. I'm raising my price target on gold to $4,000 because of these developments. Because if we push our trusted trading partners away, the last asset that they have is safe haven. It's immediately liquid, internationally recognized with no counterparty risk, is gold. And this could fuel a dramatic surge in physical gold demand around the world. That's why I think gold has such new, explosive upside potential. Okay, let's get into our technical analysis and run through the charts. This is a 1-year chart of the 10-year Treasury and the 2-year Treasury yields. As you can see off to the bottom right, how the 10-year Treasury yield has spiked dramatically higher from just at 4% to just under 4.6% or 4.55% in the past week. This is a 50 basis point increase in the yield in 1 week, which is a titanic shift in yields, which means treasuries values have tumbled dramatically. And if we look at a 6-month candlestick chart of the same information, you can see how following Liberation Day, treasury yields were dropping primarily because of the increasing fears of a US recession, but how when the turmoil erupted and treasury selling began in earnest because of the dramatic increase of the tit-for-tat tariffs with China specifically, yields spiked dramatically higher. And I've had to pencil in that dotted blue line today's 5th increase in a row for treasury yields from as low of 3.86% just 5 trading sessions ago to a high of 4.56% today. This is a titanic shift in yields. And coupled with that, we've seen the dollar take the last big leg lower that we've been looking at on the 1-year US dollar index chart. You can see last September, the dollar was at about 100 on the US dollar index chart. It rose all the way to almost 110. It rolled over following the beginning of the year. It tumbled dramatically following President Trump's meeting with Zelensky in the White House. We've detailed that in a previous video. And the last time I showed you this chart, the right hip was forming with that red parabola line, which I've now extended in blue down to the bottom with the US dollar index falling below 100 for the first time in years. This has been a dramatic plunge in the dollar. It's lost 10% of its value against other currencies since January in 4 short months. This is a big, big fall. If you're an exporter, this makes your goods cheaper in other countries. But if you're an importer, it makes your the cost you have to pay for goods higher. And now if you have tariffs on top of that, that makes it even higher. So this makes things more difficult for importers here in the United States, which could be a real problem going forward. Here's a 6-month candlestick chart that drills down a little bit farther, but you can see just in the last 2 trading sessions, which includes today highlighted in yellow at the bottom right of the chart, the dollar has plunged sharply. And this is what's helping to buoy gold so much, the inverse correlation to both normally yields and the dollar. But gold has become a true safe haven in the last couple of trading sessions, much more sharply than we've ever seen before. And that's reflected in the 1-year US gold chart, which you can see here. Gold has made a stunning 38% gain now on a 12-month rolling basis. It was trading lower in sympathy to the liquidity event when stocks were tumbling last week prior to the rescission of tariffs by President Trump on Wednesday, April 9th. And now gold has taken off in response, going from about $29.75 all the way to $32.40 today, literally off the top of this chart. I've had to pencil in today's gain. We saw 2 $100 day gains and today's $50 gain. So gold is up $250 in just the last 3 trading sessions, showing explosive upside potential. And this could be just the beginning if there is a loss of confidence in US Treasuries as safe haven. Here's a 6-month candlestick chart showing the same. You can see how gold was trading down in sympathy with stocks following Liberation Day. And then the US bond blowout started. And what have we seen since? Gold trades sharply higher 3 trading sessions in a row for a big, big gain to a new all-time high. Let's take a look at silver. This is a 1-year silver chart. Silver, despite the sell-off that we've had still has a 15% gain on a 12-month rolling period. It got a little bit below the blue trend line as it traded down in sympathy with stocks and the liquidity event. But since the bond blowout, we've seen silver surge back up. Today, it's about 32.20 in the spot market, back over short-term resistance at 32, but still well below the neckline we saw on the inverted head and shoulders pattern, which didn't break out as I thought it might if silver was tariffed, which wasn't, and you can see that on the 6-month candlestick chart. Silver was approaching the neckline at about 34.75 on this inverse head and shoulders pattern when Liberation Day came. We had the sell-off in sympathy with stocks all the way down to 28.45 intraday, and now we've rebounded $3 in just the last 4 trading sessions. So silver's showing a lot of support here as well. But with gold at 32.40 and silver at 32.20 in the spot market during the day today, that brings the gold to silver ratio a little over 100 to 1 for its second highest level on record over the last 25 years, being eclipsed only by the great liquidation event that occurred during COVID when it spiked to 122 to 1. So silver is dramatically undervalued relative to gold today at 100 to 1 ratio. Probably a steal right now at these levels. I really like it, but I do think gold also has tremendous upside potential. With our silver specials, we have Austrian 1-ounce silver Philharmonics as low as $1.99 over spot, which is low as you're going to find for a 1-ounce sovereign minted silver coin, especially one as popular as the Austrian mint. And we have a new special on backdated 1-ounce silver eagles as low as $3.49 over spot. This is the lowest price for silver eagles in the country today, bar none, while supplies last. So that's my update. We have some real problems in the United States. An inability to continue to fund our debt and our deficits by selling treasuries. Our problems are going to escalate dramatically financially. I hope that doesn't happen. But the potential is higher now than it's ever been. So this is one of the most serious gold market commentaries I might make this year. We're at a crossroads, and we'll have to see how this situation is resolved. But it truly has explosive potential for gold. So we'll see what happens. So God bless America. Good luck to all of you, and thank you for your time today.